I know I can barely see the audience right now, but we just wanted to do a quick poll. How many people out there are an entrepreneur, or how many people are raising a round of financing? Raise your hand. And how many of you are raising a seed round? Series A? Not very many. How many investors are in the audience? Oh, okay. Well, hopefully the did you guys raise your hands? Hopefully the entrepreneurs looked at the at who was raising their hands. Well, let's just jump right into it. The topic, the title of the panel is Unicorns and Supersized A rounds. I'm kind of feeling like, you know, the emperor, you know, who has no clothes. I'm kind of tired of talking about unicorns, but I think I might be the only one. But I mean, can we address that question right now? It seems like we can't get away from unicorns, and I even know that. You know, in Canada, have you heard this, that they call unicorn companies narwhals? True story. So startups that are $1 billion in valuation, like Shopify and Hootsuite, are called the narwhals of the world. What is the impact of unicorns on what you guys are, what you folks are focused on? How has that impacted your activities?
Well,
Jump into it, Emily.
I'll start, I guess. So Draper Fisher Jurvetson is an early stage investor. Mm-hmm. So we typically like to do the first institutional round and the second institutional round. So it doesn't have a direct impact in the sense that we're not going unicorn hunting. We're going hunting for great entrepreneurs that have good businesses that we think can actually ultimately become, you know, unicorns, if we want to actually look at that, you know, and believe that's actually still going to be a term that we're using in 10 years from now. So it's not something that actually on a daily basis impacts us. I think that we're really focused on, you know, entrepreneurs with big ideas that we think are going to really change the world, and then the world ultimately will decide how to actually value those. I do think there is a little bit of a derivative challenge that comes out of just the unicorn status, which is that we're looking for kind of these interim levels of success of building businesses. And sometimes you get a title, you know, building a company is a really, really hard thing. Raising, you know, hiring employees is really hard. Raising money is really hard. Getting your first customer is really hard. And there's a lot of processes. People want to believe it's kind of these, you know, tracks that go like this, or, you know, these linear paths to success, and that's just not the way it actually works. There's lots of ups and downs in that path, and that also includes, you know, raising additional capital. And even if you have a public offering, there's more scrutiny, but you're still actually building a business. And you look at the best businesses, Google's, Salesforce, the IPO was just the beginning of the ability they had to actually really transform industries. And so unicorn to me is just a label and a status that we're putting on things in this kind of interim level of success, which in some ways I think can be damaging because you're calling it too early. And people are looking for that, you know, something that it's like, look, I am a unicorn. Well, that's good. But there's still a lot of work to be done, and that's the way that we think about it with our portfolio, that some of whom have that status, some of whom don't. But ultimately we're trying to build businesses that last for the long term.
It's a commonplace term, but it's not. There are not very many unicorns if you think about it. Todd, how's it affected? Yeah.
I don't know if this is working.
Keep talking.
Okay. The biggest impact on the unicorns for us is we're Series A and B investors as well, is it shows how valuations can change so dramatically if you hit momentum. So before, when we were investing, you know, 5-10 years ago, you'd be lucky to have a $200 million outcome, $300 million outcome. Today, companies that gain momentum, because they're have such significant opportunity, the valuations can move up very rapidly. So it gets you kind of excited about what is possible with these young companies. But the flip side, and I think the danger zone, is very few companies become unicorns, yet a lot of entrepreneurs think they deserve the pre-unicorn valuations. And so this is where the market is in flux, which is there's a lot of almost great companies that are out there trying to raise money at higher prices, yet maybe they aren't going to move into that special category. So valuations just in general, even at the A round, the B round, C round, have all been moving up in the shadow of these high valuations that might be possible.
Mm-hmm. I'm sure there's a lot of wannabe unicorn companies in the audience. What advice do you have for the folks out there raising the seed round, the Series A, now that valuations are so impacted, and Todd?
Yeah. Here we go. I guess we got a mic here. I'm not sure if this is working either. Okay.
So as far as
there we go.
There we go. Seed and A. My advice would be, yeah, there's all this press on unicorns. I would
don't worry about that until you become one. Get your seed round done, raise enough to get the product out to market, raise enough to get your, move out of your apartment and get working on a product, get some customers, and that's the key, and then get to an A round.
I think this business has always been about large companies, and it's always been about billion-dollar companies being built in the venture industry and also startups. But I think just recently we gave it a name, which is a unicorn. Whereas before it was just, do you build a really large company? Is this market large enough? Is the target segment sufficiently large for you to build a very interesting company that's going to transform the world? And so for us, I don't think the unicorn conversation has really changed much, because it's just, again, are you building is the market size sufficiently large that you would build a company that can impact the world? And so that's what we focus on from day one. We do a lot of early stage investing, and so like Emily said, you can't tell on day one whether this is going to be a unicorn, but you can have good sense of, is the market large enough, is this team great, and are they moving in the right direction? So that's what we place our bets on.
We need a unicorn company with a better microphone. What do you look for in the companies then, when you're meeting new entrepreneurs? What are you looking for?
I mean, I think it's very similar to what Ben said. I mean, obviously, our business is a hits-driven business, however you want to define it. And hits-driven means that you're able to go after really, really large markets that can be transformed. And so, we're always interested in entrepreneurs that want to tackle really, really complicated, huge, hairy problems. And oftentimes when you're looking at those kinds of businesses, those are the businesses that people think you shouldn't be spending time on because they're too hard. Tesla, who wants to build a new car company? SpaceX, who's going to put rockets into the, who's going to go and compete with NASA, essentially? Those are the kind of businesses that at the time people kind of laugh at, and then 5 years later no one's laughing. And that's where we really want to dig in and spend time. But fundamentally, businesses are built by people. And we can all do as much analysis as we want around what we think the market size is, what's going to happen, but really what it comes down to is what's the motivation of this team, the grit, the capabilities to ride out the complex nature. There was a recent Wired article around Tesla and showing the ups and the downs, even post-public, almost being a bankruptcy and working his way out of it. This is not something where even Elon Musk, you have the darkest and darkest of days, and you have to keep working through them. And having that kind of a stamina to manage to do that is a very unique thing. And so we spend a lot of time looking at the entrepreneurs, why they're doing it, and whether or not they want to work with us for the next decade, because ultimately we're investing in the people.
That's a lot of advice. I like the stamina. It's a marathon, not a sprint. What else are you folks saying? He's handing it off to you, Ben.
We look for similar things. Entrepreneurs that have that grit, have the intellectual honesty, and I think at KV we like to look for entrepreneurs that are willing to work, that want and seek advice, and work in a hands-on way with the venture firm. So we're hands-on. We take a hands-on approach. We have a team of operating partners that help the team with recruiting, with hiring, with strategy and operations, a variety of different types of things. So we like to take a hands-on approach. We're not a firm that just puts the money in and then disappears. We like to play a hands-on, in a very collaborative fashion.
Value added, I think, is the term most often used. Todd, did you have some thoughts?
So I agree with the previous comments. I think the other thing I'd add is we are looking for awesome teams. Obviously, that's the number one. You want to see people who can iterate and never goes perfect. But also to have a unique vision to the customer proposition where the technology of today is going to dramatically change the customer experience. And they may be going up against major competitors. But it's been proven time and time again that you can go up against big competitors with a new product and service. Maybe it's mobile-oriented, maybe it's more tech-oriented, whatever. But you can go in and really leverage new technology to deliver a great experience. And so early on, we're looking for that team that has that unique vision. They're incredibly passionate, have some element of experience in that space as well, can be good, but not necessarily required. And then have early data points, just some early experience of working with their end user where this thing can work, this thing can move. So those are some of the other things we look for.
We were talking previously about how large rounds are and you know, we can talk about post-seed gap or Series A crunch or Series B crunch, whatever term we want to talk about. How's that impacting what you all are seeing? The larger round sizes, especially with, you know, seed stage rounds are commonly above, you know, what did you say, like 3 to 5 million sometimes? You know, what are you all seeing there? Yeah. Emily, you first.
Yeah.
Lucky you.
Never sit next to you again. So the nomenclature changes, and I think in any kind of an industry as dynamic as, you know, entrepreneurialism and venture and startups, things are always going to change. And so you just have to get used to that. What looks like a Series A 5 years ago is very different than what it is today, and it's probably going to be different. And it's always great that the industry itself has innovation. So, you know, when we did Box, there wasn't YC, there wasn't any of these angels. The kind of deal that we did as a Series A investor would never have existed today because there's just a totally different ecosystem where you have a lot more opportunities to do angel investments as well as doing micro VC funds and then going into kind of getting your more traditional Series A. The way that I think is one of the things that's impacted my life as an early stage VC is there's so many more companies than there were even just a couple of years ago because there's so many more opportunities for companies to get to a certain stage of growth. There's just a lot more access to capital, so a lot more people are starting businesses. And so we have to be a lot more, I mean, we were always discerning, but it's just a much harder process to try to figure out, you know, what are the areas that we're going to focus on? What are the companies that get to the right scale to actually rise above kind of that noise? And that's why I think you hear the Series A crunch, which is there's just a lot more volume, and there hasn't been as many, you know, there hasn't been an increase in companies or firms that are actually doing the Series A and Series B. So for me, it's a great experience because I get a lot of opportunity to meet with a lot of great entrepreneurs, and there's a great deal flow. But it's also a little bit overwhelming in the sense I feel like there's a lot of great companies, but I'm still limited in my capacity that I can only invest in a couple a year.
Yeah, the increase in the amount of seed dollars is changing the expectation for the A round. So previously, an A round would be that $2 or $3 or $5 million round where it's really a young company. And maybe it's just some people with a PowerPoint at that stage. Today, the A round, we have higher expectations because typically they've had access to seed capital. Maybe it's $500,000 seed round, or maybe as big as 3. And therefore, the A-round investors are looking for teams and products and some level of customer experience. So I think that you're right. It's a nomenclature change. Companies still go through the exact same, you know, stages, but it's just the different rounds of investment and expectations have been changing.
Mm-hmm. What about this question that? Oh, did you have a thought, Ben? Go ahead.
Yeah, for us, it's less about the terminology of the round and more about what you've already proven and de-risked, how much money you're looking to raise, and what the next phase of de-risking looks like. So it's not so much if it's a seed or if it's an A, because sometimes you're raising a $3 million A, sometimes you're raising a $3 million seed. It depends on where the team has been, what's already been de-risked, what's proven, and then what's coming up next, and how much money do you need to prove and to de-risk that next de-risking point.
Excuse me. What about this question that's come in? Do you feel pressure in today's environment to get deals done quicker? I would imagine this happens, thanks Anonymous for the question, but I would imagine this depends largely on the sector you're investing in and maybe even the geography. But do any of you feel pressure to get things done quicker than you had before?
I think it also depends on the type of partnership you're looking for, right? Because I think that most entrepreneurs do realize that choosing a venture firm and working with a venture firm and working with a partner there means that it's going to be a multi-year engagement, maybe 7 years, maybe 10 years in terms of like a marriage. And so it is it's in both parties' interest to actually spend a fair amount of time to get to know one another and not to rush the process. That said, obviously there are times when the process gets cut short, but I still think it is in both parties' incentives to take a fair amount of time to make sure that they vet both sides.
What would cut a process short? Would it be the urgency of the entrepreneur or the VC to get the deal done before
Yeah, it's really competitive, or just the fact that the entrepreneur may have choices, and their choices are coming to a close in the next week, and if you want to participate, you got to jump into it. So I think the question is, are we trying to do things quicker? No, I don't think any of our firms are sitting around saying, hey, let's make sure we do less diligence and act really fast. No, we'd rather get to, I agree, totally. Let's get to know the entrepreneur, let's spend time. I'd rather get to know an entrepreneur right after they raise their last round and know that they're not raising right now, but you get to know them over time and you get a cadence going. But you will see that opportunity where you meet someone, it's like, oh God, I wish we'd met earlier, this is coming together in 2 weeks. And so what the industry is ready to do is move quickly and get the diligence done faster than in the past and try to act within that environment. And that's what I think this faster process is really about, is that entrepreneurs have a lot of options, and it depends upon when you come to the process.
I agree with everything that's just been said. And one of the things that I think is really important is that, obviously it's a transaction, but it's not a transaction in the sense there's money exchanged, but then it's this relationship that's going to last over a really long period of time. And so making sure that whoever the investor that you're working with really understands all the risks associated with your business and is aligned with you after that money hits your bank is critical. And so it's always in your best interest not to cut short due diligence. So if you feel like someone is rushing into it, and maybe they're giving the highest valuation, but you're talking about the business and you don't think they really understand what you're doing, or they don't really understand the challenges, that could really hurt you down the road. So giving enough time to make sure that any partner that you're going to work with really understands the challenges and that you guys are aligned makes for a much better relationship going forward. And then you figure out the transaction components of it, what marker sets the price. So I don't think it's something you want to kind of fool the VCs and get them to do because it's going to come back and bite you at the end. You really want to make sure everyone understands what's going on in the business.
Right, the way that it bites you in the end is that there's this liquidation preference that stacks up. And if the company is doing particularly well, and if the underlying fundamentals of the business are good and you skip due diligence, then that's not particularly a big deal. If the underlying fundamentals of the business, there's some problems associated with it, and those aren't yet surfaced and later become serious problems, then that puts the company in jeopardy for a variety of different types of reasons. And if the company's in jeopardy, then you have to raise either the next round, which the next investor may discover these issues, or you may decide you want to sell the company. But if you sell the company, you don't want a huge liquidation preference on top of you. So you typically, I think the due diligence process helps both parties, and even some of the metrics analysis actually helps both parties, because it helps some of the entrepreneurs see these things are going particularly well, these 3 things need to get fixed, and there's actually a good clarity and alignment of expectations between the entrepreneur and the investor, and that sets for a good entry point versus like everything looks rosy, and then surprise, here are my big problems.
Yeah, I'd like to add on to this because I see more and more
Go ahead.
That entrepreneurs are getting advice from wherever it comes from, dress it up, for the investor, make sure your board meetings are all good news. This is not good advice, because you're all in it together. We are buying equity in companies. We don't get paid fees. Okay, we're not consultants. We are in the same boat. So the only way we can be helpful is to know what's going on. So if I meet with an entrepreneur, credibility goes way up if they say, hey, here's what's going well in their business, and here's what we need to tackle, here's what we need to do. Boom, now we know what to work on together. So I just want to advise people, be straight up with people, and I think it'll really pay off long term.
Well, that's good advice. I know we had some questions left over, and we could have talked more about the secondary market and what's causing all the crazy unicorn activity and lessons learned. But to wrap it up, don't worry about being a unicorn. Just stay to good old-fashioned good business sense, and the entrepreneurs will be fine. Well, Todd, Ben, Emily, thank you very much. How about a hand for these 3 investors? Thank you.